Good morning. Thank you very much for your hospitality, and my apologies for not being able to speak in Korean today. I'm Thomas Friedberger. I'm the Deputy CEO and co-CIO of Tikehau Capital. Tikehau Capital is one of the leading European alternative asset management company. We are a listed company. We manage about $40 billion of assets with a global footprint, 13 offices. And we had the privilege to celebrate yesterday the 5th anniversary of our presence in Korea. My purpose today is to explain why we think that energy transition is the investment opportunity of the century. So in 15 to 20 minutes it looks ambitious, but I was delighted to hear that Scott Kleinman from Apollo is sharing the same conviction. So hopefully it should be my job easier today. Let me start by broadening a little bit the picture. Since the mid-1980s, three megatrends have acted as extremely strong tailwinds for corporate profit generation. Those three megatrends were the continuous downtrend in long-term interest rates, the continuous downtrend in corporate taxes. Corporate taxes, GDP weighted, were about 46% in 1980, and they are now about 25%, but starting to go up. And the turning point reached in globalization. Global trade as a percentage of GDP peaked in 2008. At that time, we didn't necessarily think it was the peak, but now it looks like the trend is on and the peak has been reached. So those three trends have been extremely strong tailwind for corporate profit generation. And those trends have started to actually reverse far before the crisis in Ukraine and far before the COVID crisis. So the COVID crisis and the crisis in Ukraine are only accelerators of those trends. So in this new environment, those trends have actually allowed corporates to not only generate a lot of profits, but also over-optimize a lot of things. For example, the globalization has allowed companies to optimize production costs by going and produce where the costs were the cheapest, optimize taxes, optimize the level of capital companies were able to operate with, usually through, for example, share buybacks financed by debt. And in this new environment of higher cost for corporates, over-optimization does create vulnerability, and corporates all over the world will probably need to invest. So a new CapEx cycle is starting. The previous CapEx cycle in the 21st century has been very weak because interest rates were too low, and so it was encouraging corporates to perform financial engineering instead of investing long term. We think this is over because what the world needs and what corporates needs is resilience. So they need to build resilience through a cycle of CapEx. CapEx being considered as one of the enemies of the equity investor because only the best CapEx are performed by the best companies, the best management teams, the best governance. So CapEx creates dispersion. It's very easy to destroy value by investing long-term when you are a corporate. So all of this will probably create more volatility and more dispersion. Let me pause here for a second. We are not considering this is necessarily a bad news. Why? Because we think that the search for infinite growth at any cost to justify high levels of debt and high levels of valuation does not work. It has a negative impact on biodiversity, on climate, which is related to the E of ESG. It has an impact on social inequalities, which is related to the S. And it creates bubbles and misallocation of capital, which is related to the G. So those crises, being the COVID crisis or the crisis in Ukraine, highlighted the need for a more sustainable growth model, taking into account extra financial criteria, and we think this is the way forward. And this can only be achieved by creating resilience. And this is what we think, that for the next decade, growth will be much slower globally, but strong growth will be concentrated on a limited number of megatrends. So I'm happy to share with you here some of our investment convictions. I won't go through all of them, but clearly cybersecurity, digitalization of production processes, transformation of real assets, and energy transition, because they generate resilience, we see them as megatrends, and we've been investing and putting resources on those megatrends for a couple of years now. In the context of the costs increasing for companies, we think that energy transition, because it's a way to lower costs, is definitely becoming a competitive advantage for companies. Also, in the context of the situation in Ukraine, addressing energy efficiency of buildings, of industrial and agricultural production processes is probably, for Europe, the quickest way for European companies and countries to get less dependent from Russian gas. As a consequence, we think that companies whose core business is to enable the implementation of energy transition, therefore benefiting from strong trend, is definitely the opportunity, and this trend is global. In parallel, the most recent IPCC reports, as well as the International Energy Agency release, show that whatever happens, the Earth will reach 1.5 degrees of warming by 2030. They also highlight that we have 3,000 days, which is ballpark 10 years, to halve the CO2 emissions in order to have a chance to approach the targets set for year 2100 at the Paris conference. This would bring CO2 emissions to the same level as 1970, as you can see on this slide. And in this scenario, global peak emissions should be reached no later than in 3 years. To achieve this, according to IPCC and the International Energy Agency, $4 trillion, so $4,000 billion of investments per year are needed in the energy transition. Just as a comparison, the asset management industry has about $110 trillion of assets under management today, growing at 7% CAGR, ballpark. So those $4 trillion that might seem a very high number are actually only 3% of the global assets under management in the world. So it's just about reallocating every year 3% of the asset management of the assets managed in the world, or allocating 50% of the net new money, or a combination of the two. So it looks doable. Is it realistic? Probably. And is it happening? For sure. So now, how to allocate this amount? So this slide shows the split of global CO2 emissions. As you can see, 80% of CO2 emissions come from our non-agricultural economic system: industry, transports, and buildings. And this is why, despite the goodwill of citizens, changes in individual behavior that you can see here materialized by Greta Thunberg on the left-hand side of this slide, will only contribute to less than 5% of the effort. On the other side, investing now in loss-making disruptive technologies that will be efficient in 10 to 15 years also helps, but just explains 20% of the effort, as the transition has to happen over the next 10 years. Why? Because the main driver of the climate change is our current ecosystem, our plants, our buildings, our mobility, and the way we produce goods and services. Because what we call economic growth is actually the increase in value created by extracting finite natural resources and turning them into consumer goods that are becoming obsolete quicker and quicker, while producing waste. And by the way, those wastes are not priced at the right level. So 75% of the investments to fight climate change have to focus on transforming our current ecosystem, economic ecosystem, through energy efficiency of buildings, low carbon mobility, and renewable energies. If done well, those investments should allow to increase fourfold the installed renewable energy production capacity, to increase 18-fold the sales of electric cars, electric vehicles, and decreasing the energy intensity of the system by ballpark 4% per year. This major reallocation of investments toward the energy transition represents more than an investment opportunity. It also represents a major risk if it's ignored. Climate change involves a complete rethinking of our risk estimation schemes with potentially radical consequences for any investor. For example, in a 4-degree warming scenario, which is the pessimistic scenario given by the IPCC at horizon year 2100, rising sea levels will make part of the coastlines and cities crossed by rivers uninhabitable, reducing the value probably of real estate assets to zero potentially in those areas. So the investment opportunity is considerable. Global energy transition, the sector as a sector, is a fragmented sector composed of local companies, most often medium-sized companies, in an area benefiting from an extremely solid long-term trend. So allocating capital to the best positioned companies in this sector, benefiting from the best management teams, will allow them to expand internationally and consolidate the sector in a fast-growing market. Europe is leading the way in this area, but the United States, North America more globally, China and other major economies are just starting a dynamic that can only be strong and sustainable. So the massive reallocation of global savings to finance the energy transition is underway. The sector represents one of the most important investment opportunities of the century, and we've been investing at TKO in energy transition for the past 10 years almost, currently managing this fund, which is currently the largest private equity fund fully dedicated to energy transition in Europe. And we are now launching the same equivalent strategy in North America, with an experienced team that has started working for us there. And we are also considering exporting this expertise to Asia, because we think the trend has also started here. And let me thank you.